Thank you all for joining in. I know it's a Monday afternoon. I also know it's the last week of the quarter and the fiscal year end. So it's a busy day. But let me assure you that the insights that you will take from this short call today uh, would not only help you leverage the opportunity in front of us, a tactical opportunity albeit, but you can leverage that, but also it will give you a framework for evaluating investment options in the future as well. Right? Just to lay the context again, this is regarding the finance bill amendments that came into force on from March 24th. And this particular session is applicable only for mutual funds. Now, what is the impact and by when? Now, there are a lot of words here, but the key is that the change will come in effect from 1st April 2023. So let me break this sentence down, right? So long-term capital gains taxation treatment for mutual funds with less than 35% AUM in domestic equity. So the kind of mutual funds which have less than 35% of asset under management in domestic equity are debt mutual funds, gold funds, and others like international funds. But for this particular session, we will just focus on the debt funds because they are the closest alternatives for fixed deposits. What is happening is it's not that the taxation for fixed deposits is being brought down. It is just that these kind of funds which were enjoying the indexation benefits for so long are being brought at parity with the fixed deposits. So what is the impact? Now, the first is the loss in the inflation indexation benefit for the funds mentioned in the previous slides, right? So I'll demonstrate that better with numbers on the next slide. So you can park this point for a moment. The second impact is that the lower long-term capital gain taxation rate of 20% will no longer be applicable from April 1st. So you will be taxed as per your income tax slab rate of 30%, which I am assuming most of you on this call are already there or will be there shortly, right? So the 20% benefit versus the 30% tax rate will no longer be there, which is significant when it comes to the numbers, and you see it shortly. So this is the master slide. I want all of you to pay attention. There are a lot of numbers, but I'll try to go slowly, starting with the fixed deposit column. So one thing to keep in mind is that this tax saving that we speak about, this opportunity, is only applicable if your investment tenure is 3 years and over. And how big is the opportunity completely depends upon the principal amount, which is the next row, where we have mentioned 50 lakhs. It could be 1 crore, it could be 5 crores, it could be 10 crores as well. So the opportunity size increases as we keep on increasing the principal amount. So let's look at a fixed deposit. Suppose you decide to invest 50 lakhs for 3 years. The expected rate of return is 7% as per the leading banks, for example, HDFC and ICICI Bank as of today. Now, if your principal is growing by 7% every year, after 3 years, the maturity value would be 61.25 lakhs. We'll ignore the next item because that is applicable to the debt funds. Now, the capital gains is simply the maturity value minus the principal amount. So in this case, 61.25 lakhs minus 50 lakhs, which gives you 11.25 lakhs. Now, as per the prevailing tax rules, assuming you are in the highest tax bracket, which most of you are in, this tax rate is 31.2%. So if you apply that tax rate to the capital gains, the tax payable would be 3.51 lakhs. So final corpus post-tax would be 61.25 lakhs minus 3.51 lakhs, which is around 57.74 lakhs. And the post-tax yield of fixed deposit over the 3 years would be 4.9%. Now let's look at the debt fund short term and where the actual opportunity is. So we take the same principal amount of 50 lakhs. The expected rate of return is 7%. Maturity value, obviously, if the principal is same and the expected rate of return is same, the maturity value would also be the same, 61.25 lakhs. But this is where it gets really interesting, right? Because what the tax laws up till 31st March allows for an investor to do is the cost of acquisition becomes higher, because what we are doing is assuming a 5% inflation, 50 lakhs over a period of 3 years compounded would become 57.88 lakhs. To simplify the numbers, suppose the purchase principal amount is 100 rupees and it is inflation adjusted for 3 years at 5%, it becomes around 116, right? Similarly here, 50 lakhs becomes 57.88 lakhs. Now, the capital gains in this case won't be 61.25 lakhs minus 50 lakhs as we saw in the case of FDs. It would be 61.25 lakhs minus the inflation index cost, which is 57.88 lakhs, which comes to 3.37 lakhs. Now, if you compare the capital gains for FD and debt funds, the difference is 11.25 lakhs minus 3.37 lakhs. That's a huge saving, and that is the first element where the savings come from. Also, the tax rate in case of short-term debt funds would be 20.8% versus the 31.2% which is applied for fixed deposit. So if you multiply the two, that is 20.8%, which is the tax rate for debt funds, into the capital gains, the highly reduced capital gains because of the inflation index cost benefit, the actual tax payable is only 70,000 compared to 3.51 lakhs, which you would have had to pay for fixed deposit. Now, in terms of the tax saving opportunity in the next column, you see that is 2.8 lakhs. But another way of looking at it is 70,000 versus 3.5 lakhs of tax paid, which is your hard-earned money going out of your pockets, which is actually 1/5. 70 upon 3.5 is actually 1/5, right? Or 80% of tax savings. So that is, if you look at your investment from a tax saving opportunity, that is the quantum of tax which you will save on a principal of 50 lakhs. Now, if the principal was 1 crore, it is double the amount. So the tax savings also would double, which is instead of 2.8 lakhs, it would be 5.6 lakhs. In case of FDs, you would be paying tax of 7 lakhs. And in case of debt funds, you would be paying a tax of 1.4 lakhs, right? Now, the final corpus post-tax in this example for an FD would be 57.74 lakhs. And in case of debt funds, it would be over 60 lakhs. So 60.55 lakhs. And that's what the investor actually cares about, right? The actual money in hand. Now, post-tax yield for FDs comes to 4.9% versus debt funds, it is 6.6% because of the tax saving. So the opportunity is huge depending upon the principal amount that you invest, right? Just imagine if you were investing 5 crores in FD. Just do the calculations and you will figure out what the savings is, right? Actually, it's very simple. You just multiply the 2.8 lakhs by 10 and the savings will be around 28 lakhs if you were investing 5 crores in FD, which is the kind of corpus which folks around at the time of retirement would do, right? But there are some more insights on this slide which can help you evaluate future investment options. So my request to all of you participants is, every time you are evaluating an investment option, always always look at the post-tax yield. In this case, the post-tax yield is just 4.9% for FDs. Now, the problem with that is, if we are assuming an inflation of 5% over the next 3 years and the post-tax yield is 4.9%, your so-called investment in FDs is not even beating inflation. So you're actually losing value after 3 years of investment because the cost of goods would have increased. The key takeaways are, number one, the tax saving opportunity is big. The post-tax yields of debt fund short terms against fixed deposit is huge, but you have to take action, and you have to take the action now because this advantage disappears after 31st March 2023 forever. I want to emphasize on one important point. The expected rate of return here we have taken as 7% for debt fund short term. That is actually conservative. And I say it's conservative because the yields of debt funds currently between 2 to 3 years, all the top quality funds, which we generally give to our clients, is hovering around 7.5 to 8%. If you net the expenses out, it is a little over 7%. With that, I would like to turn it over to Anu.
Yeah, I would request if anyone wants to ask questions, please raise a hand and I'll unmute the person. And so there is one question, Arjun.
Yeah.
What is the, you showed an example with 25 lakhs or 50 lakhs, right?
Right.
So what if the amount is different? Like if it is 25 lakhs or say 1 crore, how can that be calculated then?
Suppose you want to invest 25 lakhs. So the tax saving is 1.4 lakhs. Again, the savings is 80% compared to FDs, but the amount is 1.4 lakhs versus 2.8 lakhs in the previous slide, right? 35,000 versus 70,000 there, and 1.75 lakhs versus 3.5 lakhs in the last one. So it is, you half it, you multiply it by 4, the impact remains the same, the post-tax yield remains the same.
Okay, thank you. There's another one. We consider the inflation as 5%. What if there is an increase in the inflation, say for example 7% or 6%? How can that impact this one?
Actually, that's a great question. Actually, if the inflation is 7%, then based on the inflation index cost of acquisition, if you think the expected rate of return is 7%, and the inflation is also 7%. So the cost of acquisition becomes the same as maturity value, which basically means the capital gains become zero for debt funds, right? And taxation of 20% of zero is zero. So it will actually help in saving more tax if the inflation index is higher.
All right. Okay. Thanks for that, Arjun. Any other question from participants?
Just tell me. So, what is the recommended advice? What is to be done? Get to the crux. What do you guys advise?
So, if you want to, I think that's Jasjeev. Jasjeev,
yeah.
You can live without the liquidity for the next 3 years, right? And you want to get a decent yield. Then, in a volatile environment, then you should invest in short-term debt funds in this week itself. Like I said.
You see, Arjun, 3 years. 3 years is a long term only. 3 years is, if 3 years one is to wait, it's between 3 and 5. There's nothing much, at least for an individual perspective. So it's better to go long only.
Yeah, it's always advisable to go long, but if somebody has just decided to keep it in fixed deposit, because I have a couple of clients who are extremely conservative, right? So we manage retirement funds for most of our clients, and because it is retirement funds, they do not expect a lot of volatility, and they definitely cannot afford to lose the capital, right? So in that case, it makes sense for them. There's another way to think about it also, right? So one way to think about it, suppose I have invested in fixed deposits and it's maturing shortly, right? Within the next 1 month or so. And there is a penalty associated with mutual funds also, fixed deposits also, if you try to withdraw them. If you can do the maths and see the difference between the savings here, if you invest in debt fund short term if you were planning to renew those kind of fixed deposits, right?
Well,
And take the penalty, and this saving might make sense to
no, no.
actually liquidate them also. So there are multiple
Got
use
it.
cases. It depends on the client,
Fair,
actually.
fair enough. Thanks.
Yeah.
There's one more question, Arjun.
Yeah.
That what is the impact of market condition changes on these funds?
Okay, good question. I just want to emphasize here again, we are talking about debt funds here, right? So a lot of people mistake mutual funds and put it under a general umbrella of, say, they are like equity funds. They are not equity funds. Debt funds only own debt papers, and they are high quality debt papers. So the chances of default is very, very low, and based on their return profile, they are not volatile also. So in fact, all the experts, now that the RBI has kept on increasing rates from almost 4 to 6.5%, right? And they're expecting another 25 basis points hike. But thereafter, everybody is expecting the interest rates to go down. And how debt funds valuation typically works is that as the interest rates go down, the value of your fund goes higher. That's why I mentioned earlier on that the 7% that we are actually assuming is on the safer side to be unrealistic also, right? Chances are that you will make a little more than 7% on your debt funds as well. What everybody is concentrating on, unfortunately, even the mutual fund folks, they're concentrating on how something which was a benefit for our industry has been taken away right now by the tax authorities. But what a lot of us miss looking at is the opportunity that sometimes crisis so-called for the debt fund industry, a mutual fund industry, can be an opportunity. And that opportunity can be for the clients, right? So for a person who's about to invest, say, 30 lakhs or 50 lakhs or a crore within the next 1 week, because he or she is bombarded with these newspaper articles saying that the taxation benefit is gone, everybody will rush towards fixed deposits. But here I showed you clearly that the opportunity is even bigger for people who are familiar with how the funds work, right? In this case, the debt funds, and how the taxation structure works, and what is the implication of the tax change on the end value. But what I encourage all of you to do is, every time a proposal comes in front of you and you are evaluating an investment, always calculate the after-tax yield. And the second biggest part is liquidity. In fixed deposits, I forgot to mention one thing, right? There is a penalty if you withdraw early. What if I've invested 50 lakhs now? I need 20 lakhs 2 years from now. Say, I've blocked it for 3 years, but I want 20 lakhs for whatever reason, right? I want to travel abroad. I want to do anything. There's a good property that has come up. I want to down pay for that. But in an FD, you are locked. If you withdraw the money, the penalty will be charged, which will further reduce your after-tax returns. With debt mutual funds, you tell tomorrow, we can liquidate it immediately. So safety of capital, liquidity, and returns, in that order is how you should evaluate all your investment decisions.